If you've ever searched for investing advice online, you've probably come across the phrase, the holy grail of investing. It's everywhere. A secret formula, a perfect strategy, a single indicator that will make you rich overnight. Podcasts promise to reveal it. Books claim to have found it. YouTubers swear they're using it. And millions of investors, from beginners to seasoned pros, spend years, sometimes decades, searching for this magical key. I want you to pause for a moment and ask yourself, have you ever fallen for this? Have you ever clicked on a video promising the one indicator that beats the market every time? Have you ever bought a course that claimed to have cracked the code? Have you ever spent hours tweaking your portfolio based on some secret you just discovered? If you have, you're not alone. But here's the hard truth that no guru wants to tell you. The holy grail of investing does not exist. Not because no one has found it yet, but because it cannot exist. Investing is not a puzzle with one right answer. It's a complex, dynamic, ever-changing system influenced by millions of human decisions, emotions, geopolitical events, technological disruptions, and an enormous amount of sheer luck. And the more you chase the perfect strategy, the more money you lose. Not just in trading fees, not just in bad bets, but in opportunity cost and mental energy. Every hour you spend searching for a shortcut is an hour you could have spent building real, sustainable wealth. Today, I'm going to explain why the Holy Grail is a myth, why so many smart, educated, well-intentioned people keep falling for it, and, most importantly, what you should do instead. By the end of this video, you'll stop chasing illusions and start building real wealth. Let's dive in. First, let's define exactly what we mean by Holy Grail in the context of investing. The term itself is borrowed from Arthurian legend, the mythical cup that knights spent their entire lives searching for. In investing, it refers to the idea that there is a single, repeatable, foolproof method to beat the market consistently, with minimal risk and maximum returns. For some people, the Holy Grail is a specific technical indicator, like the Relative Strength Index, the MACD crossover, or the Golden Cross on the moving averages. They believe that if they can just master this one chart pattern, they'll be able to time the market perfectly. For others, it's a timing strategy, like buying at the beginning of every month, or selling in May and going away, or following the January effect. They believe that the market follows predictable seasonal patterns that can be exploited. For still others, it's a portfolio allocation, like the legendary 60-40 stocks to bonds ratio, or Ray Dalio's all-weather portfolio, or the permanent portfolio. They believe that there is a single asset mix that will protect them in every market condition. And then there are those who chase the latest fad, meme stocks, crypto, NFTs, option strategies, leveraged ETFs. Each new trend promises to be the one that changes everything. So why do we keep chasing? It's because we are neurologically wired to seek certainty. Our brains hate randomness and unpredictability. We crave patterns, rules, formulas, anything that makes the future feel knowable and controllable. This is a survival mechanism that served our ancestors well. But in the context of modern financial markets, it works against us. And the financial industry knows this vulnerability intimately. That's why they package and sell proven systems and secret strategies, because they know we'll pay handsomely for the illusion of control. It's a multi-billion-dollar industry built entirely on our psychological weaknesses. But here's the fundamental problem. The market is not a machine. It's a complex adaptive system, influenced by millions of human decisions, emotions, news events, government policies, technological shifts, and, yes, an awful lot of luck. No single formula can account for all that complexity. And the more complex and rigid you make your strategy, the more likely it is to fail catastrophically when the market inevitably changes its behavior. Now let's look at the cold, hard data, because the numbers don't lie. Consider the SPIVA report. That's the S&P Indices versus Active Scorecard. It's the most comprehensive, long-running study comparing actively managed funds to their benchmark indices. Over the past 15 years, more than 85% of actively managed mutual funds have underperformed their benchmark index. That's not 85% in one bad year. That's 85% consistently year after year. Let that sink in. Professional money managers, with teams of full-time analysts, access to terabytes of market data, proprietary trading algorithms, and decades of cumulative experience, cannot consistently beat a simple, low-cost S&P 500 index fund. And if that weren't damning enough, the numbers get even worse over longer time horizons. Over a 10-year period, over 90% of active fund managers fail to beat their benchmark. Over 20 years, that number climbs to over 95%. So the longer the time frame, the worse their performance. But wait, you might be thinking, what about the ones who do outperform? Surely that proves it's possible. And you're right. Some do outperform. But here's the critical detail. The ones who outperform in one year are almost never the same ones who outperform the next year. Performance persistence is essentially random. Last year's winner is just as likely to be next year's loser. It's statistical noise, not genuine skill. A famous study by researchers at the University of California found that the majority of active fund outperformance can be attributed to luck rather than manager skill. When they ran millions of simulations, they found that the number of funds that outperformed due to chance was almost identical to the number that actually outperformed in reality. So if the professionals, with all their resources, education, and experience, can't find the Holy Grail, what makes you think you can? I'm not saying this to discourage you. I'm saying it to free you. Once you genuinely accept that there is no secret formula, you can stop wasting your time, energy, and money on the search. And you can finally focus on what actually works. So why do otherwise intelligent, educated, rational people keep falling for the Holy Grail myth over and over again? It's not because they're stupid. It's because our brains are wired with powerful cognitive biases that make the myth feel undeniably true. Let me walk you through 3 of the most dangerous psychological traps. Trap number 1, the illusion of control. When we face uncertainty, and the stock market is nothing but uncertainty, our brains go into a state of heightened anxiety. We feel powerless, vulnerable, and exposed. To soothe that anxiety, we create rituals, rules, and systems that make us feel like we're in the driver's seat, even when we're not. You've probably done this yourself, checking stock prices obsessively, setting stop losses at arbitrary levels, tweaking your allocation every time you read a news headline. These actions give you a false sense of agency. You think you're actively managing risk. But in reality, you're just feeding your own anxiety. And the worst part? Studies in behavioral finance show that active trading, especially frequent trading, actually lowers returns for the average investor. The more you tinker, the more you underperform. So the illusion of control doesn't just feel good, it costs you real money. Trap number 2, confirmation bias. Once you latch onto a strategy, say, buy the dip or follow the 200-day moving average, your brain becomes a powerful filter. You actively seek out information that confirms your strategy works, and you conveniently ignore or dismiss any evidence that contradicts it. You vividly remember the 3 times your indicator correctly predicted a rally, but you conveniently forget the 7 times it gave a false signal. Over months and years, you build a mental case that you've found the edge, but it's a carefully curated illusion. A famous experiment by psychologist Peter Wason demonstrated that people overwhelmingly prefer to test their beliefs by looking for confirming evidence, not disconfirming evidence. That's confirmation bias in action. And in investing, it can keep you married to a losing strategy for far too long because you're only seeing what you want to see. Trap number 3, survivorship bias. This is perhaps the most seductive trap of all. You open a finance magazine or watch a YouTube video and read about a legendary investor who got rich using a specific technique. Maybe it's a particular option strategy or a concentrated bet on tech stocks or a unique value investing framework. That story is incredibly inspiring, and it makes you think, if they did it, so can I. But what you don't see are the thousands of other investors who tried the exact same technique and lost everything. They don't get magazine covers. They don't get interviewed on podcasts. They are silent and invisible. So your mental database is completely skewed. You only have data from the winners, not the losers. A classic example, during the dot-com bubble of the late 1990s, countless day traders made enormous fortunes on paper until the crash wiped them out completely. We only remember the ones who got out early. The rest simply disappeared from the record. If you base your decisions on the stories of the survivors, you're building your entire strategy on a foundation of missing data. These 3 traps, the illusion of control, confirmation bias, and survivorship bias, have been studied extensively in behavioral finance for decades. They are not flaws of character, they are flaws of cognition. They affect everyone, from complete beginners to billionaire hedge fund managers. And they are precisely why the Holy Grail will always remain just out of reach. The moment you think you finally found it, one of these biases is probably pulling the strings behind the scenes. Now for the good news, and I promise there is good news, there is no Holy Grail, but there is a proven, time-tested path to building long-term wealth. It's not exciting, it's not secret, and it's not complicated. Here's what decades of academic research from Nobel Prize-winning economists like Eugene Fama and Kenneth French to legendary practitioners like Warren Buffett and John Bogle have consistently, unambiguously shown. These are not opinions. These are evidence-based principles that have stood the test of time across multiple decades, multiple market cycles, and multiple economic conditions. Principle number 1, broad diversification. Instead of trying to pick the one winning stock, or the one winning sector, or the one winning country, own a little bit of everything. A low-cost global index fund gives you exposure to the entire investable market. You don't have to guess which sector will outperform next year. You don't have to bet on which country's economy will boom. You simply participate in the long-term growth of the global economy. Principle number 2, keep your costs low. Every dollar you pay in management fees, trading commissions, or taxes is a dollar that isn't compounding for you. Over 30 years, a 1% annual fee can eat up nearly 30% of your final returns. That's a staggering amount. So choose low-cost index funds and ETFs with expense ratios under 0.2%. This is one of the few variables you can control, and it makes a massive difference. Principle number 3, maintain long-term discipline. The market goes up and down in the short term, sometimes wildly, but over decades it has always trended upward. The key is to stay invested through the volatility, not to jump in and out based on news headlines or emotional panic. The worst mistakes investors make are buying high because they're euphoric and selling low because they're terrified. Discipline means doing the opposite. Principle number 4, reinvest your dividends. Let your returns compound on themselves. Albert Einstein reportedly called compound interest the eighth wonder of the world, and he was right. But compound interest only works if you leave it alone. If you keep withdrawing your gains, you break the compounding machine. That's it. There's no secret indicator, no special timing, no proprietary algorithm, just diversification, low costs, patience, and reinvestment. And here's the kicker. This boring, simple approach has beaten the vast majority of active professionals over any 10-year period. It's boring, but it works. Now, some of you might be thinking, that's all well and good for traditional stocks and bonds. But what about all the exciting new opportunities out there? What about crypto? What about gold? What about commodities? What about the next big thing? It's a fair question, and it's incredibly tempting to allocate a portion of your portfolio to alternative assets, especially when they're surging and everyone around you seems to be getting rich. And let me be clear, there is nothing inherently wrong with a small, speculative allocation to alternative assets, as long as you fully understand the risks involved. A 5% allocation to crypto or gold or commodities can add a bit of excitement to your portfolio. It can even provide some diversification benefits in certain market conditions. But here's the danger. When people chase alternative assets, they are often looking for that holy grail, a quick win, a shortcut, a way to beat the market and get rich fast. And that mindset leads them to make disastrous decisions. They overallocate. They buy at the top because they see others making money and they have FOMO, fear of missing out. Then when the inevitable correction comes, they panic and sell at the bottom. They lock in their losses and they derail their entire long-term financial plan. The research is absolutely clear. The majority of wealth generated in alternative assets is captured by institutional investors and early adopters who got in long before the hype. By the time an alternative asset reaches the mainstream retail market, by the time your Uber driver's telling you to buy it, the risk-reward ratio is almost always heavily skewed against you. So my advice is this. Keep alternative assets to less than 5% of your total portfolio. Treat them as fun money, as a gamble, not as your core investment strategy. Your core should be that boring, diversified, low-cost portfolio we just talked about. That's what will get you to retirement. That's what will build real, sustainable, lasting wealth. Now let's get practical. Here are 4 concrete, actionable steps you can take starting today to stop chasing the Holy Grail and start building real wealth. Step 1. Define your goal and your timeline. Are you investing for retirement in 30 years? Or are you saving for a house deposit in 5 years? Or maybe you're building an emergency fund that you might need access to at any moment. Your financial goal and your time horizon should determine your asset allocation. Don't use a long-term growth strategy for short-term savings. And don't be overly conservative with money you won't need for decades. Be honest with yourself about when you'll actually need the money. Step 2, set a simple, clear asset allocation. and rebalance it once a year. For example, you might decide on 80% global stocks and 20% government bonds, or 70-30, or 90-10. The exact numbers matter less than your ability to stick with them. Then once a year, on your birthday, or the 1st of January, you rebalance. That means selling some of what has done well and buying more of what has lagged. This simple discipline forces you to automatically buy low and sell high without any emotional guesswork. Step 3. Automate your contributions. Set up a monthly auto investment from your bank account directly into your chosen funds. This is perhaps the single most powerful thing you can do. It removes emotion from the equation entirely. Your dollar cost averaging, investing a fixed amount every month regardless of market conditions. You don't have to think about market timing. You don't have to make difficult decisions. You just execute consistently month after month. Step 4. Ignore the noise. Turn off the financial news channels. Unsubscribe from the stock-picking newsletters. Delete the apps that send you push notifications about market movements. Stop checking your portfolio daily or even weekly. Research consistently shows that the more frequently you check your portfolio, the more likely you are to make bad decisions based on short-term volatility. Your emotions will tempt you to buy high and sell low. The best thing you can do is to make it harder to act on those emotions. So let's wrap it all up. The holy grail of investing is a myth, a seductive, persistent, and costly illusion. But that doesn't mean you can't build wealth. It just means you have to stop searching for shortcuts and start embracing the boring, proven principles that have worked for centuries. Diversify. Keep your costs low. Stay disciplined. Let time do the heavy lifting. That's the real secret. And you already know it. Now the only question is, will you act on it? If this video helped you see through the hype, drop a comment below. What's one investing myth you used to believe? And what changed your mind? Hit that like button if you found this valuable. It helps others discover this content. And subscribe if you haven't already. I post weekly videos on building wealth the smart way. Thanks for watching. I'll see you in the next one. Until then, stop chasing ghosts and start building real wealth.